लेकिन मेरा ये इससे करो, इसको हटा दे क्या, इसको हटा देगा फिर इसे इसका स्पीकर। Good evening, viewers. Sorry for the tech glitch a little bit. We are about to start in about a minute or so. Okay, guys, we'll start with the our analysis of the budget that we have from our perspective. Now, the finance minister went into the budget with a lot of challenges, and these challenges were also kind of a pre-COVID challenge that existed. Uh, the economy as such was struggling with poor growth even before the pre-COVID times. The private sector companies have excess capacities and they had limited room for increasing private sector spend. The government was also struggling with by managing fiscal situations, lower tax collections, and hence the expenditure was not that much to boost growth. Uh, come COVID, come COVID, the challenges only increased for the government. The government had to spend a lot of money in social expenditures to ward off the COVID problems. There were reduced tax collections because of lockdown. So the entire budget was on the backdrop of these challenges, and each one, the corporate sector as well as individuals, were waiting for their share of goodies from the finance minister. The corporate sector basically were hoping that the budget is growth oriented. There is huge amount of spend on infrastructure. There is a support towards sectors that are under stress, and there is a boost towards manufacturing sectors to capture the opportunity that exists in front of us because of a declining or a disruption in the supply chain because of COVID that has happened. On the other side, the individuals were basically hoping that they get additional tax relief under Section 80C, because the last 80C relief that we have seen was in 2014. They were also hoping that either the rebate could come in the form of increased standard deduction or increasing the basic slab rate. These were the hopes of the people at large. Now, there was also a fear in some part of the community which we hope anticipating there could be additional tax on account of COVID impacted spend that the government has done. There could be a long-term capital gains tax increase or additional cess, but not increasing this tax rate was also a good news. So if I actually have to really pinpoint this budget was all about priorities. The government had to make choices, and the choices were between boosting the corporate sector or giving freebies to the individual at large. Moving towards growth or fueling growth in the economy versus fiscal consolidation. These were the choices that the government had to make. And very rightly so, the budget was a very strong, positive, growth oriented budget with a focus on infrastructure spend. This was also coupled by an attitude that had kind of a relaxed attitude towards managing fiscal deficit. Now, if I recall, it was in US post 2009, the US government also allowed the fiscal deficit to increase in order to fuel growth. So Indian finance minister did precisely the same thing by letting fiscal deficit slip to 9.5% this year and 6.8% in financial year 2022, and gradually tapering that fiscal deficit to 4.5% by 2026. And that's a bold step, because at this time the need of the hour was not focusing on fiscal deficit alone, but it was also on trying to fuel growth in the economy. Secondly, if you look at the budget rightly allocated a very high amount of capital expenditure, which was almost 5.54 lakh crores vis-a-vis 4.4 lakh crores that happened in the past year. There was substantial allocation towards road and infrastructure that could revive the investment cycle. So that was one. The second was there is a focus on getting efficiency via asset monetization and disinvestments. So many public sector undertaking, there is always a question mark on the efficiency. The government plans to go for a divestment target of 1.75 lakh crore and ensure that there is two public sector banks that get privatized, one general insurance company, IPO of LIC, and there's an increased FDI limit to fund infrastructure. In FDI limit from 49 to 74% for insurance company. They have also set up a new development financial institution to fund infrastructure projects and promoting competition in the power sector. Uh, there now, if you look at the last almost 2 years, there has been absolutely very bad for corporate credits. Banks have suffered a lot of NPAs. They have a lot. There has been a lot of defaults in the corporate market. So the need of the hour was to actually stabilize that corporate credit market. So the government has set up Asset Reconstruction Company Limited to buy stressed assets from banks. That's one. Asset management companies to buy investment grade bonds. The first will help banks' lending ability, while the latter will provide liquidity to the corporate credit market. So the another good steps to improve or revive corporate credit that is there was struggling. Coming to direct taxes, as I said, government prioritizes to support corporate sector over providing relief to individuals. There were no changes in the overall income tax rate, no ITR. So what happened? There were few changes which was more towards creating ease of filing return. So people who are 75 year and above, they are no longer required to file ITR for themselves. So there are some negative per se. In fact, I have, as I write out here, I have got some queries on my chat which say the budget is not so good for the middle class people. At you absolutely right in a way. Government should middle finger to the middle class. Okay, I mean, I would put it differently. The government had very limited scope to actually allocate the money that it had, and as I started the my discussion or analysis, that the government has to prioritize or make choices between giving some leeway to the individuals or the corporate. So they chose to give a very strong impetus or boost to the corporate segment, which could create job, which could help fuel growth in the economy and get the GDP back on track. So that was the with the aim that the government started. Yes, if you ask me to be very honest, given the fact that from 1st April, the new wage code will apply where a person's salary 50% has to be a minimum basic and their allowances. So if that were to get implemented, people will have a higher amount of PF deductions. Now, with that into play, this year, interest amount over and above 2.5 lakh on employee provident fund will be taxable, which is a negative. The majority proceeds of ULIP amounting for annual premium that is over 2.5 lakh rupees will no longer be tax free and will be taxed like mutual fund, that is 10% long term capital gains. It's come at par with equity mutual fund. Now, however, in fact, the interest on deduction on home loan of 1.5 lakh rupees got extended by a year. There are few other changes which has happened, which means a more of a very easy way of redressing complaint appellate. I will not go much into detail about it, but the fact remain, yes, the ease of actually filing income tax will increase. And this year we have seen a huge amount of increase in the taxpayer. We have approximately 6.34 crores people who have paid tax this year. So it's a great increase there. Now, uh, so you will have option of pre-filled taxes, capital gains calculated using artificial intelligence and analytics. A lot of data analytics has gone into that. So I think there's an ease of filing return, but if you actually boil down to basic tax exemption, which the individual were hoping, yes, they are completely disappointed and they are right in their own perspective to get disappointed. But given the current situation that you see out here, very limited scope that the government had to actually allocate the money. So they were basically putting money in instead of, say, when you have your own household budget, it is good to use the budget in creating asset than consuming. So what they actually focused on, actually giving a boost to corporate sector, doing a huge amount of infrastructure spend, that will more of asset creation, and that asset creation in turns will create job opportunities, will create growth in the economy. So if you look, actually break down the GDP of a country, it's based on four pillars: consumption, private sector spend, government spending, and net exports. So consumption, there has been a muted demand which exists because in last year people did not spend that much. There have been huge savings that has happened. So that the pent up demand, the government anticipated that consumption will take its own course to come back. So they did not do much out there. But what they have done is they have actually spent a lot on the government spending side. The capital allocation to government spending sides has increased to 5.54 lakh crore. That will put the GDP very back on track. Finally, because with the interest rate at such a low level and many top corporates borrowing at between around 4% thereabout, so it's a great time for them to really look at, and a lot of projects become viable at this time. Having said that, I don't see that anything much will happen immediately, but it's a great starting point for them because it interest rate at such a low level, a lot of projects become viable at that cost, interest cost. So huge There could be additional capacity expansion that we could see, and some of them have already announced capacities, which will be a big boon for India's growth story. Setting up of the textile park, giving up ease of doing business work. So these will also be a boost to the manufacturing segment. There has been some amount of custom duty that has been increased on, say, mobile component, solar inverters, uh, cotton, and so these things will basically create competitiveness for Indian companies and enable them to actually become contribute to the growing to the struggling economy. So how does it all stack up? So this budget basically has given complete uh, kind of a firework to the struggling economy. The government is spending a lot of money there, focusing on privatization, boosting the corporate credit market, and coupled with a low interest in environment, it all will boil down in a good investment cycle. And this is very, very positive for the equity market. Secondly, the government for a moment did not focus much on fiscal deficit, and it is good in a time such like this. It is at times good to allow fiscal deficit to go a little bit low, and or rise, the fiscal deficit rise out here, uh, and play that trade off between growth and fiscal deficit. So the government played the trade off for growth, compromising a little bit on the fiscal deficit side. Now, so this fiscal deficit is a negative for the debt market and bond funds, and right, and you've seen the bond yield jump very drastically. So one has to be very cautious while investing in bond market. So you have to ensure that you don't play actively duration, and only if you have a long term money that duration could be played from. So this is exactly what happened in the 2004 to 2008 cycle. So when there's a huge impetus on growth, then you will see the cyclical or a value stocks do well. And we feel that this is an era when the cyclical stock like banks, metal, infrastructure, and even stocks in the mid and small cap category will do well. There's a high growth budget which will fuel cyclical and value sectors, mid and small cap sector on the equity space. So the portfolio construction has to be met, keeping that in mind. Now, what should the investor do? No, it is very difficult for investors and advisors at this point of time, because the equity is available at an elevated risk level, at a very high valuation level. The interest rate is an all-time high. Now, coupled with higher than expected fiscal deficit, interest rate is bound to rise. So this is negative for bond market. And from here, you can have the frenzy of excess liquidity drive the equity market a little bit much more. But what will happen is, to make money from these levels is not going to be very easy. So one has to really manage greed and fear very, very judiciously to ensure that you make money from the equity market. So the equity market, the party of the equity market, as I said, may continue for some time more given the fiscal impetus and also the excess liquidity that is there in the overall world economy. But I would like to caution you that the valuation levels are very high. It's extremely difficult, and it is in such bullish environment that most mistakes do get uh, occur, and most people actually uh, make these mistakes of investing not so rightly in these market levels. For example, if you actually are driving, most accident will happen on a very speedy highway, deadly accident. But if you're driving on a crowded road or street, the accident could be there, but that may not be that deadly. Okay. So in this kind of bullish or frenzy environment, you can see a scenario where you can actually hit a bad accident. So you have to trade with very caution. So a systematic investment plan or a systematic transfer plan is advisable at this level. balance your greed by not putting your ad hoc allocation to equity at these levels. Now, similarly, in the debt side, you have to ensure that you run a low risk debt fund. And only if your money is for a period of 3 year and above, okay, then only you can look at a dynamic bond kind of a fund there. So, given that situation, in this current market, you asset allocation can be a great virtue, and I would actually expect people to follow a good asset allocation in this market to ensure that you don't get your risk distorted, and you follow a very disciplined approach of investing in this market, because the markets are going to be extremely volatile in times to come. Now, just before the budget, if you look at the market from 50,000 in no time went down to 46,000. And as the budget was favoring the equity market, the market rallied in no time 4,000 back. So you have seen an 8,000 point movement in less than about a week's time. So I think it shows the volatility that could come in future also. Any small bad news that could actually hurt the economy. Now, what are the risks that exist in the economy? The risk is of unwinding. For any reason, if the easy liquidity environment in the market goes away and US starts to raise rates, then you will see the equity market collapse. Now, this is exactly what happened post the 2008 2009 crisis in US, subprime crisis. Excess liquidity gave up almost a week kind of a recovery to the market. But thereafter, it took a long time. What is called a time correction in the market happened, and the market struggled in that range for a longer period of time. So, in the given scenario, I would reiterate the importance of asset allocation and trying to manage risk rather than chasing returns and greed at this point of time. So this is what I have to say. So I will possibly try to take, expecting that the market will go down just before budget. Fincard was expecting the market will go down mostly by 6 to 8%, but that becomes completely untrue. Could you please enlighten on same? Okay, we have been concerned about the market valuation level. Mihir, let me give you an answer on this. When you do a valuation, the valuation is done using discounted cash flow mechanism. It's called DCF. Now, based on the discounted cash flow mechanism, the market is trading at 40 PE, and a 40 PE, a discount rate of 0.25% is justifiable. Now, if you look at a 0.25 rate, it's available mainly in US, not in Indian market. So a lot of FIs may find this 40p valuation okay to them, but to us it's very expensive. So we were hoping that the market will correct, and from 50,000 it corrected to 46,000, and it went up. So, and in all humility, I would like to acknowledge and accept that we go by rational and data and numbers. We are not an expert in timing the market, and I accept in all humility that we are not great at timing the market. So we will not be a good guide to you in time to time the market, but we will have all the data points and rational to tell you when is a good time to invest and when is not a good time to invest. When you should be investing cautiously, when you should be investing without caution. Unfortunately, if you go by data, most people invest when there's a bull run in the market, and you'll see huge money flowing into the segment, which is currently happening. But this is the time when one should look at risk and tread a cautionary part rather than blindly chasing return. Having said that, can the market go from 50 to 55,000, 10% more up? Absolutely, it can go. Yes, I have, as I said, I can never time the market, and I will never intend to time the market. We are investing in a very cautious way, and we feel that rationality or sense will prevail in some time, and investing is all about patience game. So we will we have some allocation in equity. We'll continue to manage the asset allocation well for our client, because it's to us, it's not about managing return, it's about managing risk. It's not about creating the wealth, it's also protecting the wealth that we have created for people. Why was there been a dip in the bond fund? Is it a cause of concern? See, the bond funds dipped because the fiscal deficit, which the market was expecting for FY22, was 8%, but the forecasted is about 9.5% for this year. FY22 is 6.8%. Hence, it is more than the market expectation, and hence the bond market had adjusted to that risk or additional borrowing that may come in. That is why the bond market has actually dipped. So bond market is fairly simple. If you stay invested for a period of 3 years, the knee-jerk reaction or the certain loss that you see will get recovered over a period of time, because it's purely based on bond mathematics. Nothing to worry about. It's not like equity. Foreign investment in insurance sector has opened up more in this budget. How would it translate to common man insurance policy and premium paid in thought? See, basically, the FI's limit has increased of investing. So you could see some more foreign players coming into the market. But and as we have seen in the earlier side, when the private sector bank or the foreign banks came in India, it increased the banking experience. When the foreign cars came into India, you have a better choice of cars. So when these foreign companies come with the insurance policies, we could see more variety of policies and better product variant in the marketplace. That is what we will see in times to come. Pawan is asking, would you recommend moving large investment from dynamic funds to low risk fund and then move back in a year? No, not really. In a dynamically, if you're referring to dynamic bond fund, so let me clarify, Pawan. If you're referring to dynamic bond fund, and if your time horizon is 3 years, do not worry. If you have invested in dynamic bond fund and your time horizon of investment is less than 6 months or 12 months, then you can look into low risk fund. This is fun. But if you're looking at dynamic asset allocation fund, then you do not need to change your fund. The fund manager itself will take a call. That is why you have given the charge to them. So if you have any more questions, I would love to take it through. I've been answering the question on the chat box. Please fill in your more commentary and question in the chat box if you have. I would be happy to take your questions. So I would sum up my saying once again that it's a budget where the corporate sector has been given a preference over individual. It's a budget where growth has been given a preference over fiscal consolidation. So I think the loss that an individual will have uh, on account of the tax expectation, because I also agree that the 80C last was revised in 2014, and it certainly has not kept pace with inflation also. It was due for revision, and somehow not having it come by, I think that is a big disappointment for a lot of people. Some say something about ULIP. Naresh, yes, ULIP premium of over 2.5 lakh rupees, if you invest, it will be at par with equity mutual fund taxation. Until now, any premium that you pay in ULIP, which had a 10-time cover, the entire proceed was tax free. Entire maturity proceed was tax free. Now, if you have annual premium is 2 lakh and 2 lakh and above, 2.5 lakh and above, for policies that has been purchased from 1st February 2022-21 onwards, it does not apply to the old policies. Those policies will have a long-term capital gains tax on it. I am investing in IDFC low duration fund. What advice to change it to balance to advantage fund for 3 years horizon? For a balance advantage fund for a 3 year horizon, it's a little bit more risky given the equity valuation that you have. I would prefer a dynamic bond fund to that. rather than balanced advantage fund, or at best an equity savings funds there, Hemil. Avinash, how much approx correction we should wait to invest in physical gold or gold fund after custom duty? See, the gold funds, the gold has corrected. In fact, let me give you a perspective on gold before I actually answer your question. See, many believe that gold is a very safe asset class. But let me give you the journey of gold post 2008 and until now. When 2008 happened, subprime crisis, the gold, when I say gold, I'm referring to the US dollar price per ounce, went almost to $2,000 an ounce. When the growth came back in the system, then the fear or the risk uh, tapered off. The gold prices came down to almost $1,100 per ounce. So now, and then again, when this COVID incident happened, the gold touched almost $2,000 once again, only to settle around 1,800 thereabout right now. So gold is, yes, a perceived safe asset class, a perceived risk or hedge against inflation. But having said that, this gold should be a part of your asset allocation, should be best tagged to a particular goal like a children marriage or so. And this could be like a pickle in your thali, not more beyond that, because it is equally volatile. And if things go well, and if liquidity unwinding happens once again, and us starts raising interest rate, you might see gold collapse also, like it happened last time. So you have to be very careful when you're investing in this asset class also. Keep one more thing in mind, that when investing in a gold fund or gold bond, keep a horizon of 5 year and above to ensure that you don't get bad experience. I trust I have answered your question, Avinash. Naved, the corpus which was booked due to excessive valuation sparked in debt. How should we plan to reenter? A very good question, Naved. Right now, you can create three buckets. So what has happened is, a very short term could be in your liquid fund or low risk fund. For 3 year time horizon, you can look at a dynamic bond fund kind of a horizon if it's debt. Right now, because of a sharp rise in the equity market, the futures have started trading at a very good level. It is almost at 55 basis point over spot level. So this again is a great investment opportunity to get back to arbitrage fund vis-a-vis a liquid fund right now. So this kind of rejigging your portfolio will help you to actually earn that extra few percentage points, few hundred basis points from different asset class, to ensure that you actually build a better return to your portfolio. Now, for example, if you are a bond could be a scenario where you could be at risk, then what you could do, you could actually look at real estate listed REIT as a substitute to bond to just jack up the overall portfolio yield. These kind of combination will be able to reconstruct your portfolio and ensure that your yield stays ahead of the curve, and you don't worry much about the falling bond yield market. I agree it is difficult to time the market, but Fincard expecting to go the market down to Sensex. Okay, Sensex 38,000. It's very difficult to call the market level. Yes, we started booking level from 40,000 thereabout, but the market today has gone to, as I said, 50,000. It's trading at 40 PE. Now, if I do the reverse of PE, is earning by price. Means 40 means it's 2.5%. 40 divided by 100 is 2.5%. It means the equity yield is 2.5%, whereas your bond yield is much higher. So given the current situation, that is where the risk in the equity market remains. Now, when this market will correct, there is two kind of correction. One is called price correction, when you expect the market to correct from 50,000 to 38,000. This is called price correction. So the other way of correcting is the market may remain at 50 and 45 and 50 for a long time for the coming 2 3 years also, or remain between 45 and 55 for 3 year 4 years. That is called time correction. That itself is a correction equivalent to 38,000 index. So one has to manage the portfolio from that perspective, Mihir. And I repeat, reiterate, it's very difficult to time the market. So when I actually am managing a portfolio, it is my fiduciary responsibility to take care of your money with utmost care. And I do not want to actually put my risk appetite when I'm managing your portfolio. My risk appetite could be very high given my understanding of the market, but I cannot treat everyone's portfolio like that. So I have to be cautious when I'm managing portfolio, and hence we take a lot of measures to ensure that we have adequate risk management matrix in place to manage your portfolio. Nifty P is expensive zone. Should we still park funds in debt? See, debt and equity, Nifty PE is for equity market, not for debt funds. Debt fund is very different. Shravan, I hope you understand that. So if you have another question, I would be happy to answer your question. So Nifty P is expensive, and hence we are trying to stagger the investment and reiterating. So for example, what Mihir asked, there is two scenario. One, can the market can correct, so I'll buy all the way down way. For second scenario is, instead of price correction, time correction happens. If time correction happens, I still buy my equity at this level over a period of time. And hence, in both the scenario, I average my investment out and ensure that when the next bull run were to happen, I am well placed with accumulated enough units to actually ensure that my next flight is equally happy. Okay, I will be happy to take more questions if you have, friends. Thanks, Vivek. I hope you liked the session. Thanks for your appreciation. Thank you so much, Meir, for writing. Any more questions if you have? I'm happy to say take your questions, and you can also write in your questions to your respective relationship managers. We'll take it, or you can write your questions to info@fincard.com. We will be happy to take that question. Thank you, Ashish, for your appreciation. I equally enjoyed as much as you did. So if you don't have any question, we would like to end the session. Thanks, Tejas. Thanks, Naresh. Uh, Guys, I think we have no more questions right now, and I would like to end the session. And I would like to thank you all. We have had a fantastic participation from you people, and thank you very much for joining in for the session today. I hope you found it valuable, and we will do everything to ensure that the portfolio is well aligned to the market risk, and we manage this difficult time with lot of careful hand holding. Thank you so much.